Sarbanes-Oxley Act, or SOX, is a United States law created to protect shareholders and the general public from accounting errors and fraudulent practices in enterprises and to improve the accuracy of corporate disclosures. The Act sets deadlines for compliance and publishes rules on requirements. This law was created due to the public outcry surrounding ethical misconduct and fraudulent acts or scandals by executives of Enron, WorldCom, and many others. The Sarbanes-Oxley Act paved the way for the creation of the Public Company Accounting Oversight Board, or PCAOB. The PCAOB is an independent quasi-government oversight entity. The board has statutory authority that regulates public accounting firms that audit public clients. It performs periodic inspections of audit firms expected to restore and enhance the public confidence in the auditing profession. In the Philippines, the practice of accountancy is regulated in accordance with the RA 9298, or also known as the Philippine Accountancy Act of 2004. The Professional Regulatory Board of Accountancy, under the supervision and administrative control of the Professional Regulation Commission, or PRC, may be considered the Philippine version of PCAOB, since the Board of Accountancy's powers and functions include regulation of the practice of accountancy, including those engaged in public accounting. Section 406 of Sarbanes-Oxley Act requires public companies to disclose to the Securities and Exchange Commission whether they have adopted a code of ethics that applies to the organization's Chief Executive Officer, Chief Financial Officer, Controller, or persons performing similar functions. If the company has not adopted such code of ethics, it must explain why. A public company may disclose its code of ethics in several ways. They can include it as an exhibit to its annual report. They can post it to their website, or by agreeing to provide copies of the Code of Ethics upon request. A company's Code of Ethics should apply equally to all employees. The Code of Ethics assists management and employees in understanding the difference between right and wrong, and in applying that understanding in their decision-making and behavior. Attendance and punctuality, conflict of interest, anti-bribery and corruption, and general harassment and sexual harassment are some of the examples of the contents of the Code of Ethics. Top management's attitude toward ethics sets the tone for business practice. But it is also the responsibility of lower-level managers and non-managers or rank-and-file employees to uphold a firm's ethical standards. The written Code of Ethics must address the following ethical issues in compliance with Sarbanes-Oxley Act: conflicts of interest, full and fair disclosures, legal compliance, internal reporting of code violations, and accountability. In conflicts of interest, the company's code of ethics should outline procedures for dealing with actual or apparent conflicts of interest between personal and professional relationships. In full and fair disclosures, the organization should provide full, fair, accurate, timely, and understandable disclosures in the documents, reports, and financial statements that it submits to the Securities and Exchange Commission and to the public. In legal compliance, codes of ethics should require employees to follow applicable governmental laws, rules, and regulations. Doing the right thing requires sensitivity to laws, rules, regulations, and societal expectations. To accomplish this, organizations must provide employees with training and guidance. In internal reporting of code violations, the Code of Ethics must provide a mechanism to permit prompt internal reporting of ethics violations. This provision is similar in nature to Sections 301 and 806 of Sarbanes-Oxley Act, which were designed to encourage and protect whistleblowers. The best example is the establishment of employee ethics hotlines. Finally, in accountability, an effective ethics program must take appropriate actions when code violations occur or happen. This will include various disciplinary actions and measures, including dismissal. To learn more about ethics, fraud, and internal control, click the video on the left screen for the next lesson.